Trump, he just picked his next Fed chair, Kevin Warsh. And if Warsh gets confirmed, we could see big changes in how the Fed handles rates, inflation, and market confidence. But here's the part most people are missing. Mortgage rates are still relatively high, and home prices, they're holding and in some cases climbing again. So what does that mean for you if you're trying to buy right now? I'm Karl, your San Diego realtor, and in this episode of the Mortgage Market Update, we're talking with Matt Kish of Movement Mortgage to unpack these two big topics: what Kevin Warsh could mean for the future of mortgage rates, and how should buyers be thinking about strategy when prices are holding and in rising in some cases, even with rates still elevated. But first, let's kick things off with a quick look at where mortgage rates are this week. As of February 5th, here's what we're seeing reported by Mortgage News Daily. First, we got the 30-year fixed, which is the most common loan for buyers. That's sitting around 6.17%. The 15-year is averaging 5 3/4. The jumbo for anyone over 830,000 is near 6.35%. FHA is sub 6%, and so is VA loans. And for those of you considering ARMs, adjustable rate mortgages, those are close to 5.5%. Each of these is slightly down from the week prior. And overall, we're still sitting in that high 5% to low 6% range we've been hovering in for weeks now. Keep in mind, rates can change daily, sometimes even hourly, depending on what President Trump announces that he ate for breakfast, what the bond market is doing, how lender conditions are unfolding, and how your personal scenario lines up. Things like your credit score, your loan type, your down payment, etc. So do not assume these are your actual options. If you're looking to buy or refi, you'll want to talk to a lender directly to get real numbers based on your file. And as always, I recommend speaking with Matt Kish over at Movement Mortgage. He's local, he's sharp, and he can help you figure out what's realistic and what kind of strategy might give you the best long-term value. All right, now let's get into the first big headline. President Trump has announced his pick for the next chair of the Federal Reserve, Kevin Warsh. If that name sounds familiar, it's because Warsh served on the Fed during the financial crisis from 2006 to 2011 and was known for being pretty hawkish on inflation. Hawkish meaning that he believes that the Fed funds rate should stay up or elevated to retain inflation at a sustainable rate. But recently his tone has shifted, and that's what's got the market super rattled. The question is now, what version of Kevin Warsh are we going to get? And what could that mean for mortgage rates, bond yields, and the overall lending environment if he is confirmed? Let's check in with Matt Kish. Let's see what he has to say and what he's seeing on his side of the industry.
Well, it's a great question. We're not really talking about it too in depth right now. And truthfully, market expectations haven't gathered any momentum around it either. It's just basically more or less of we have his resume, right? We know a little bit more about Kevin Warsh than we would about somebody that hasn't really been in this arena before. He was a Fed commissioner from 2006 to 2011. So he really knows, and especially you look back at those years where he was doing his thing in the Fed. Those were some pretty rough years as far as policy is concerned, right? From 2006 to 2011. So the guy knows what he's doing. Traditionally, though, he was kind of more of a policy hawk. Like, he needed to see the policy and the data going forward before he really made his decisions, right? But on the inverse side, we kind of know that the president wants to put somebody in there that's just openly and willingly ready to cut interest rates. So we're really ready to see which Warsh is going to show up, right? Is it the one that the president elected, or is it the one that's kind of been a policy hawk throughout his career and needing the data before he makes a decision? So I'm really interested to see. But as far as the mortgage industry, we're on a stand and hold because he still has to get confirmed. He still has to pass the Senate. What we do know, like I said, he's going to be more likely to maybe have openness on lowering interest rates. He's definitely going to focus on economic growth and credit conditions and make sure that the markets are right, hopefully, before he makes any decisions. What we don't know is like how aggressively he will cut rates, if at all, whether or not he'll fully defend the Fed's independence. And that's kind of been my point along the lines too, is the Fed has to remain independent and can't just be a lapdog for politicians, or this whole thing's going to go sideways. And that's kind of been my fear of whoever was going to get in the seat. Kind of just, if we played the tape back, and seen what this industry could do to the world economy. It could really blow things up if we don't have policies in place and firm firewalls in place to make sure that the Fed remains independent. With a new Fed chair in and somebody that is more favorable to this president, and just kind of listening what like Scott Bessent is saying and other people in the Treasury, I really think we're going to be set up for a rate cut one way, shape, or form. Like this person is being put into this place to lower interest rates, in my humble opinion. How low he could really go, given the other economic structures, is the big question. Is you can't really just go out there and say I'm lowering interest rates and not really have any policy to back it up. So I'm really interested to see how low we could go and what this new Fed chair is willing to do as far as push the limits of independence, and we'll see where it goes. But I think we're going to be lowering interest rates. I just don't know how far we could go given the current economics.
Now, on the lending side, here's what's happening. Even with mortgage rates sitting in the low sixes, home prices, especially here in San Diego, are staying elevated. And in some micro cases, they're still climbing. So if you're a buyer right now, what do you do with that? Do you wait for rates to drop? Do you try to save for a bigger down payment in the future? Or is now the time to get in, even if it feels uncomfortable? This is a really interesting question. I asked Matt to break down how he's guiding buyers through this market, especially those who are stuck between affordability concerns and the fear of missing out. Let's hear what he had to say.
As far as a strategy to get in, it's we're kind of limited, right? It's always going to be the temporary buy downs. It's always going to be negotiating costs somewhere to ease the overall financial cost of getting them into a home. But on our end, it's timing the market, right? It's listening to our tools and reading the data ourselves to kind of forecast the right time in history where we could really capture the best time to lock in an interest rate, right? We really saw the momentum come and go these last couple months, these big peaks and valleys in these interest rates. And we've been able to time it up very, very well, fortunately, given the data that we've been receiving on our end. And so it's just making sure that if we are going into a live escrow, right? Like say we're putting in offers today and we're trying to get into a live escrow. I'm really watching the markets today, kind of forecasting, am I going to be in a position to lock at the beginning of this escrow, or do I need to kind of float it along and kind of not think about the rate on this particular file for a while, because that's going to be really crucial. I really got to take little snapshots in time to make sure that we are gathering all the information and locking at the right period, because these lock periods have been 12 hours, 48 hours. Very, very short periods to capture the gains in the market before they come and go. Because like we've been saying for almost a year now, is these markets have been swaying with just daily news, a tweet, and not so much forecasting past and into the future. It's just daily right now. Interest rates are moving and grooving, and we got to be ready for it when it peaks and when it valleys. If you are saving money double the rate of appreciation, then go save money, right? But how fast are you saving that money compared to how fast the value of these homes are growing, right? Are you always going to be behind the curve? And if the answer is yes, you should probably think about pulling the trigger and getting into a place sooner than later. But if you're able to save at an exponential rate that's capturing your savings faster than the market is appreciating, then maybe you should hold off a little bit, save a little more, and get yourself into a better position. That's all, it's going to be very borrower specific and how fast you could save money. But if the answer is no, I can't save money as fast or faster than the market is appreciating, then you should really think about getting into a home so that you could be there while it's appreciating, right? Because that's your forced savings account. Every time that you pay your mortgage, you're building that piggy bank. You're taking money from your right pocket and putting it into your left just by living there every month. So if the answer is yes, I could save faster than the rate of appreciation, you're probably in a good spot anyway, and you could probably afford to wait.
So here's the takeaway. Markets are watching Kevin Warsh like a hawk, pun intended. But until we get confirmation and some clarity on his policy stance, expect continued volatility. And for buyers, the message is pretty clear. Even if rates stay sticky, prices aren't really backing off as much as we would hope so. That makes strategy and timing more important than ever. If you're thinking about jumping into the market, now's the time to ask the right questions. Don't just go out and start shopping open houses. Contact me, say, hey, we want to make an offer on this one if you haven't talked to a lender. This isn't just about rates. It's about what kind of payment actually works for you and how to protect yourself if the market shifts again. If you need help figuring that out, reach out to me or Matt direct. We're always happy to talk you through your options. And that's a wrap for this video. Don't forget to like and subscribe if you haven't already. As always, I'm Karl, your San Diego realtor. I'll see you next video.